Many thanks for joining us for this morning's briefing on the national accounts and international accounts results for 2021 and our updated results for Q1 2022. We'll take questions at the end of today's presentations on the results, and can ask people to use the chat function on the Teams platform for the questions. Also, we have some people in the room with us here today. So for those people, obviously the old-fashioned way of raising hands, if you have a question at the end of today's presentations. And again, just as the people are in the room, in case of a fire, we go through the door here, down the back stairs and out the back exit, and CSO staff will lead you to the designated assembly positions. Okay. Today's results are updated results for 2021 and Q1 2022, giving us a more definitive picture for Q1 2022 and for the earlier quarters and years. In these mid-year publications, we include the additional or updated data from across our sources that feed into the national and international accounts, and the colleagues will take you through the revisions this morning. Also, in today's briefings, we'd like to take the opportunity to present some of the more detailed analysis available in the annual results and some of the new detail and developments that are included in the publications. Morning slides will be available along with the statistical publications on the CSO website, and we're hoping to load a recording of today's presentations to our YouTube channel. Contact details are available on the statistical releases and on the press release, and so please contact us at any stage today or after on and with any queries. So I'll pass to Chris Sibley now, who will take us through the national accounts results, and then Chris will pass on to John Sheridan to take us through the international accounts results. So many thanks, Chris.
Thanks, Jennifer. Good morning, everyone. I have the new set of annual national accounts for you for up to 2021 and the restated quarterly 2022 results. The main message today is that the GDP growth rate is unchanged for 2021 at 13.6%, up marginally from what we had for the sum of the quarterly data for the year. GNP is up to 14.7%. But I think the main message is about GDP is largely unchanged. The reason we're here today with the annual national accounts, what's different in the annual national accounts? CSO gets lots of additional microdata and data sets from revenue, the corporation tax, income tax, PMOD, P35. So those data sets bring a whole new set of data in through for 2019, 2020 to 21, along with reclassifications across different NACE and industry sectors. This we combine with our structural business surveys, final data for 2020 and preliminary estimates around 2021 for sensitive industrial production and the annual services inquiry. Then we get updates for trading goods, monthly trading goods statistics, as well as John's international accounts. So bringing all this together along with what we call the commodity flow process, looking at everything that's produced minus everything that's exported to look at the consumption in Ireland and give us weights and boundaries on consumption. It gives us a new set of data for the years leading up to 2021. So for a lot of the data, particularly our quarterly accounts, you have a new base for the data and the trends that we see off that new base of 2020. So the constant price data would have been 2019, and it's now off a base of 2020 in the quarterly data we're going to show you for the next today and for the next 4 quarters. There's a couple of new developments in the publications today. There's a new format that I'll talk about in a moment that we've renamed the publication to the annual national accounts. We normally have stages of production through the summer, what we give to you now in August, September, and perhaps in October, and we add to the publication. Most of those tables are ready today and they're in the publication, and we've reordered the publication by the topic rather than when the tables are produced. And I'll show you that in a moment. We've 3 other issues. We've distributional data on wages. So the continued work we've been doing on wages or compensation of employees. For today's publication, we're able to look at the distribution of the wage bill across 2021, and we have back data on that too. One of the interesting things with that is you can look at the 10% growth in current prices and wages in 2021 and see what parts of the distribution grew the most. We've also developed a new set of volumes data for the health sector. So previously we would have looked mainly at employment related data to look at constant prices in health. And we've done extensive work looking at the numbers of people treated across different types of healthcare. And that's given us a new volumes indicator. And the last big change, I think, for today's publication is we've reviewed suppression. So many of the sectors of industry have been suppressed since 2015. What we've been able to do is reveal a couple more sectors, in particular what I'm going to talk about today, medical devices or medtech, which I think is quite interesting. That's the look, I guess, of the new format publication. So the table of contents on the right-hand side, I guess, gives you the best kind of illustration that we've grouped together the things under income, like wages and profits, GDP by producers, which is the intermediate consumption and output data, and GDP by expenditures, which you're typically used to looking at consumption, investment, and the foreign sector net exports. So the tables that would be produced at stages throughout the next couple of months are here today and in the order of topic instead of, I guess, when they're produced. But I'll leave you to look at that publication yourself. The infographic on the front page takes that theme as well. So GDP by incomes, by producers, and by expenditures. And it shows you the domestic sectors along the top. So wages are up 10% in current prices. Domestic sectors are up 5% in 21, and personal spending is up 5%. So the domestic effect on top, and the layer underneath, looking at profits, foreign sectors, and exports up by a much greater extent. The headline numbers are up there. So the eye-catching one, I guess, there is GNI Star. It's up quite a lot at 15.4%, and I'll explain that in a moment. MDD is at 5.8%, down marginally from what we published in the sum of 4 quarters data for 2021. One of the first things that many of you do is look at the current price data for GDP as a denominator. So for health, education, spending, and for government debt and deficit. So the current price data has changed marginally for 2021. It's gone up from 421 million to 426 million. And then combining that with the new data today that we have on GNI Star at 234 billion, down from the GDP number of 426. So for those of you who are not used to looking at GNI Star, the main transition items to get from GDP to GNI Star is to take off the multinational profits. And that's notably over 100 billion for the first time in 2021. So that's the first movement from left to right there, from 426 to 323 billion by taking off the net factor flows or the M&E profits. There's a small change for EU taxes and subsidies to get us to the EU concept GNI. And then the set of new globalization adjustments of nearly 90 billion to get us down to GNI Star of 234 billion. The globalization adjustments to make up the 90 roughly fall into 70 billion for the IP related depreciation, 10 for aircraft depreciation, and another 10, quite a large 10 for the PLCs in 2021. So that transitions us down from GNI to GNI Star at 234 billion. We can then use those current price levels of GDP and GNI Star to look at the government debt and deficit. So the debt ratios here are down 2021 over 2020. There's a couple of things there. My government colleagues point out to me that debt has actually increased, but GDP and GNI Star have increased at a faster rate, and that's why those ratios are down on the debt side. On the deficit side, you've got lower pandemic-related spending, along with increased taxation and the increased denominators of GDP and GNI Star, to leave you a government balance for GDP of minus 1.9 and GNI Star of minus 3.5. So that's the latest debt data that we have. The government colleagues will be producing new or updated debt figures next Wednesday, the 20th. But to move away from the current price to constant and the growth rates. So the large growth we see in GDP and GNP is followed by the large growth in GNI Star and NNI. NNI is a new indicator we introduced, internationally comparable indicator we introduced last year. And we spent some additional time looking at this. So we expected a bounce back from the pandemic fall in GNI Star in 2020. So the fall in 2020 was minus 4.6%. So we expected something greater than that to come back in 2021. So 15.4% is quite strong. And NNI picks up some additional issues and growing by over 20%. So The domestic data, for example, the wage growth, even at current prices, is just under 10%. That would have given us kind of a bar that we expected with this. The levels, so as a level indicator, what GNI Star was designed for, that's broadly consistent with the pre-pandemic trend, 18, 19, skipping 20 into 21. But what we're seeing from analysis here is that there's a lot of M&E effects on the domestic GNI Star indicator. And we spent some time looking at those, but I think we're going to need to do a lot more analysis on it to come up with, I guess, the measures of how much each of these are affecting the data. We're certainly looking at timing issues between 2020 and 21 profits, M&E profits, of when they're flowing out. Build up of stocks, we've been watching that in the quarterly data. So contract manufacturing related stocks, particularly in the industry. And then we've been looking at additional tax payments. So the data that accrues from production in 2021, that's yielded a lot of additional corporation tax. And you're seeing that in the payments that are coming through since then, right up to even to May now in 2022. The additional effect on NNI is the PLCs. The PLCs' income's doubled in 2021. So that's what's given you the higher NNI growth rate in 2021. So at this stage, about the most we can say, each one of these affects those GNI Star and NNI growth rates by a couple of % each. There's no silver bullet in there. So we're expecting a strong rebound in GNI Star, but it's a little bit stronger than many of you may have thought you'd see in that. So we certainly could take more questions maybe at the end on the deglobalized measures. Just returning to the annual data, that unchanged 13.6% GDP growth still leaves us in the far right of a set of European, more countries than were available a month ago when we last spoke to you about the growth rate. Just to talk to you about the changes, what's different in the data. Industry is down. In current prices, it's the easiest way to look at it. Industry is down, while the ICT sector, financial sector, and professional and admin's up. So those two offset, leaving you the same GDP growth rate for 2021. If we look at the foreign-dominated and other sectors, so this charts the pandemic quite well, I guess, in 2020 and the growth in 21. The M&E dominated, or sorry, the non-M&E dominated or domestic side of the accounts there is showing us 4.8% growth, slightly lower than the 5% that we had in the Q&A. Just some of the new features then I talked about in the annual accounts. We've a new set of data on health. So we looked at the numbers of people treated in various different parts of the health system to come up with a volume indicator or deflator for the constant price data. So the current price data is unchanged. It's the amounts spent. But with new deflators, we have a real value-added series here for human health activities, which shows you what you may have expected, the fall in 2020 related to the pandemic and the bounce back in 2021. So we think that's an improvement. It's also used in our quarterly data. So you should see improvements there in the Q&A, but we publish it at an annual level. So you can see that in today's accounts. I mentioned the review of suppression, and we've freed up a couple of the industry sectors. You'll see those in the detailed tables. But I think the main change that most of you probably agree is what comes in as other manufacturing, a hidden sector at the end of industry. This is dominated by medtech or medical devices. And we haven't been able to analyze or look at this since 2015 because of the suppression. But this has grown strongly from 1995 all the way up to today. But the new data for you today looks at the strong growth from just nearly 5 billion in 2015 to nearly 11 billion in 2021 for medical devices. That puts it right up there, one of the biggest sectors in industry. And given the focus we have through FDI and medtech, I think that's quite useful to look at. And the green line shows you the share of manufacturing. So despite the rapid growth in manufacturing, and particularly some of the other sectors, medtech or medical devices here has maintained and increased its share. So I think that's an important analytical sector to be able to show to you today. Just to show you some of the other features in the annual publication, we have GDP by producers. So this looks at the output method, and it breaks down the output method into intermediate consumption and value added. So the value added you're used to looking at this gives you another dimension on intermediate consumption or costs. So when you add the intermediate consumption onto the value added you're used to looking at, then you get up to output, or what you'd normally kind of call turnover. So what you see in the high frequency kind of monthly business statistics from CSO will be these turnover indicators. And this threads it quite nicely into our national accounts and value added, looking at it through the output method. So for example, in construction, you can see that intermediate consumption or costs make up a large part of turnover, leaving you a lower share, which is value added. So there's lots more data in the publication on that. For the income side of the accounts, and we've lots of interesting features in the income data, particularly around wages. But the key measure or the key message from the income side of the accounts is that wages, or the labour share, is just under a third of GDP. And we've lots of breakdowns on that, but that's the blue segment on the top right there, compensation of employees or wages, while what we call gross operating surplus, or depreciation and net operating surplus or net profits, makes up the other 2/3 of GDP. And lots of people look at that for a domestic and foreign split of the data as well. But you can take that kind of analysis and then show it by the components, and we can look at the income side of the accounts and say, well, how much do M&Es contribute towards wages? And they're about 17% of wages, while the bottom line there shows you the overall contribution of M&Es to the economy is about 53%. So that's the M&E dominated and non-M&E dominated sectors at the bottom bar. And it's showing you things that contribute to that. Wages on the top, where M&Es contribute about 17% of wages, while M&Es are the bulk of profits and depreciation. This is the new distributional wages that I mentioned. So we've taken the monthly PMOD data that you've seen our colleagues produce new indicators on. We use it for quarterly wages, or the wage bill. And this shows you where the wage bill kind of comes from across the distribution. You can see the concentration, like in most of the income distribution data. The contribution is coming from the kind of the 30 to 80,000 euro bins there. That gives you the bulk of the wage data that makes up the third of GDP. We also looked at this, which I think was quite interesting, to look at growth. So if we look at the change in wages, so wages are a third of the economy. In current prices, wages have gone up 10%. And saying, well, how did all these individual categories grow during 2021? While the overall average is 10%, you can see the higher parts of the distribution grew by more than that. And below 30,000, there was some falls there. So we have the time series on that. What I'd say to you is this chart and the one before it are very much experimental for us. We're hoping to produce a more developed publication later on in the year for this. So any feedback would be greatly welcomed on the COE data, on how to portray it and what kind of messaging even to look for that might be useful to produce for you guys. On the expenditure side of the accounts, the GDP by expenditures, this is largely unchanged for 2021. Most of the revisions here relate to exports, so industry on one side and exports on the other. The main issue, I guess, for most of you is modified domestic demand. That's now at 5.8% for 2021, down from the 6.5% we had in the sum of quarters that were produced in the Q&A. And similarly, with the non-M&E sectors, MDD also charts the pandemic quite well, the fall in 2020 and the rise in 2021. In the annual publication, we also give out, as we always do, increased detail on consumption. Normally this comes a little bit later in the year. This is in the publication today. There's about 30 categories of consumption in the publication tables. And this is in current and constant prices, and it also builds up into the work we do on actual individual consumption. So you see individual spending and the spending on behalf of individuals by government as well, to give you the total actual individual consumption. And this is quite nice to compare across EU countries. But the detail in the actual tables today shows you the rebound in spending on hotels and restaurants, furnishings, equipment and maintenance, as well as clothing, while there's some falls in 2021 over 20 on transport, mainly related to cars. Lower spending on cars in 21 over 20. So that's for consumption. And the other important part of the expenditure side of the accounts is investment. So there's also increased detail on the investment data. So we give out detail on the slides on investment on a quarterly basis, but the publication doesn't have it. It does in the annual publication. And I think the big message there is the increase in other machinery and equipment. And this is the data we've been discussing each quarter, and two things. One is the spending on data centers, and the other is the return to work and the spending, the broad-based spending by firms in Ireland on office machinery and equipment and hardware for their own businesses. So that's, I guess, the main message, I think, in the investment data and the domestic effect from the investment data. So just to sum up on the annual accounts, we have GDP largely unchanged. We have a strong GNI star growth rate of 15.4%. And the NNI, the new NNI indicator is also very strong, 20%, as it's affected particularly by the PLCs. But looking around the slide there, the other areas, the non-M&E dominated sectors on the left, is still showing us 4.8%. MDD on the right-hand side, the expenditure modified measure at 5.8%. So all of these, and along with PCE, are still showing us the same kind of figure in the 4 to 5% range, 4 to 5, 6% range for the domestic economy. But a notable feature, I think, in 21 is that the net factor flows have gone over 100 billion. The profit outflows have gone over 100 billion for the first time. But GNP is still up 14.7%. I'll just run through the quarterly, just to tell you again what's changed. I've cut out a lot of what I normally talk about, but just to dwell a little bit on what's different. For the people looking at the high frequency data, this is a lower growth rate. We had 10.8% and now it's at 6.3% of GDP. And the main thing to remember here is we have a new base. We have a new set of data for 20 and 21, and this data is trended from that into Q1 2022. So you have a new base, you have a new set of constant price data with the 2020 base instead of 2019 base. And we've rerun our seasonal adjustment process as well. So we have a review of seasonal adjustment this time of year, and we have a new set of weights on that. So roughly what's changed in data, industry is down from what we had of about 15% growth in industry down to 7.9. ICT is down from 4.3 to 0.1. The key domestic sector there, distribution, transport, hotels and restaurants, that was showing strong growth in our early estimates, and that's down now, down by nearly 1%. Construction was down 3.7%, and that's up marginally. So quite a few changes across the sectors with that new set of data from the annual. But I guess the key takeaway for most people is that modified domestic demand on the bottom left of the infographic is unchanged at minus 1%. So lots of revisions to the M&E data, but the domestic data is largely unchanged with MDD at minus 1%. Even that lower growth rate of 6.3% still leaves us on the far right of a set of European countries, with increased countries in now over when we came to you with the first set of data a month ago. And the M&E, as I said, and non-M&E data is weaker, I guess, with the weaker GDP overall coming down. Both of these have to come down as well. So the M&E dominated sectors is up 5.6%. And the non-M&E dominated sectors is up 2.2. So we had that at 7.6, and it's now down to 2.2, the non-M&E dominated sectors. Again, largely because of base revisions. On the expenditure side of the accounts, where you can, again, peel off the globalized activity and look at modified investment and MDD, this is unchanged, as I said, at minus 1%. But looking in the elements of it, one notable item that I think many of us like to look at is consumption, what we spend on goods and services. The comparison across European countries, a month ago when we looked at this, you were in the middle of the chart. We've gone down a little bit with more countries becoming available. But the consumption data is largely unchanged. But I guess with more countries coming into that chart, it's pushed us to the left a little bit. Particularly with the CPI released yesterday, there's a large focus on inflation and the effect inflation is having. on the data in the national accounts. We've always had effects, globalized effects of prices, mainly related to exchange rates and how they've affected the data. But the domestic data hasn't had these kind of price effects in quite a while. And there's an illustration of what happens with the consumption that we have in blue, and with the increased prices we see in the consumer price index, that's giving us a real effect of consumption, which is a lot lower. And that green line is what you're seeing as the consumption contribution to the economy, or to the real GDP growth rate. So that consumption effect is being dampened because of the price changes in the economy. So looking at the modified domestic demand and its contribution to growth is still the same. A small negative in Q1 2022, and it's largely M&E effects that are giving you the growth rate. So to summarize for me, the quarterly GDP for Q1 is down from 10.8% to 6.3%, with some changes across the sectors, mainly because of base effects. On the output or income side on the left there, the M&E and non-M&E dominated sectors, they're both down, from pulling them both down because of the lower GDP growth rate. But MDD on the expenditure side is unaffected at -1%. So I'll hand over to my colleague John now for the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts. We have data revisions from Q1 2020 to Q1 2022, but we also have updates to our series on redomiciled PLCs, our current account star data, and our US current account. So looking first at the revisions to Q1 22, we can see that it's virtually unchanged from the start of June when we published them. Our merchandise surplus is the same. Our services balance has decreased by 102 million, and our net income outflows have increased by 215 million, all combining to give us a current account balance of 17 billion euros, which is down 317 million on the previous figure. Looking at the revisions to 2021, we can see our merchandise surplus is now 167 billion euros, which is down 5.6 billion on the previous figures. Our services balance is now 577 million euros, which is up 3.7 billion on the previous figures. And our net income outflow is now 107 billion euros, which is a decrease of 3.8 billion on the previous figures. And these all combine to give us a current account balance of 60.7 billion euros, which has increased by 1.9 billion on the previous figures. Looking at 2020, we can see bigger changes. Our merchandise surplus is down 2.7 billion euros to 142 billion. Our services balance has decreased by 9.8 billion euros, which is largely driven by new IP imports in the year, giving us a services balance of minus 71.7 billion euros. And our net income outflows increased by 3.1 billion to 96 billion. And these all combine to give us a current account balance of minus 25.5 billion euros, which is down 15.6 billion euros on the previous figures. Looking at how these spread out across the quarters, we can see for our current account balance that the main changes are in 2020 Q3 and 2020 Q4, with further change in 2021 Q4. Looking at the constituents of this, we can see small changes in our net merchandise, predominantly in 2020 Q1 and 2020 Q2. But for our net income balance, we can see larger changes in 2021 Q4 and a small change in 2020 Q1, which is driven by new information for the year. And then looking at our net services balance, we can see the big changes in 2020 Q3 and 2020 Q4 that are driving the changes to the current account balance. And these are predominantly driven by increased IP imports in those quarters. So today, we've also published updated redomiciled PLCs information. The redomiciled PLCs have net income inflows, which act to reduce our total net income outflows. So we can see here the blue line is our net income outflows, and the green line is what they would be without the inflows to the redomiciled PLCs. We have a large increase from 2020 to 2021, with the inflow moving from 4.3 billion up to 10 billion. And this is quite broadly based across our population of redomiciled PLCs. and is not due to a change in the population of redomiciled PLCs. Looking at direct investment abroad, we can see total FDI abroad has increased to 1.3 trillion in 2021, and just over half of this is due to the redomiciled PLCs. Looking now at our deglobalized measure, the modified current account balance, or CA star, we can see here the CA star series is the green line and our current account series is the blue line. And we can certainly see that the CA star series is much smoother than the current account series. We do have some revisions to a large part of the CA star series, which I'll go into in more detail on the next slide. So we're getting for 2019, CA star of 15.1 billion euros, for 2020, 13.1 billion euros, and for 2021, 26 billion euros. With this increase being driven largely by the same effects we're seeing on GNI star as Chris described. Looking at the revisions to CA star, this is largely being driven by revisions to our depreciation adjustment series. So you can see that it's bringing the level down almost right across the time series, but with the impact getting smaller as we go back due to the reduced stock of IP. The larger revision in 2020 is a combination of this revision to depreciation adjustment series, but also the reduced current account balance that we saw in the overall revision. Looking at our modified current account balance as a percentage of GDP, we can see again a fairly stable time series. For 2019, it's 4.2% of GDP. For 2020, 3.5% of GDP. And for 2021, 6.1% of GDP. Just to look a bit more closely at the adjustments we make to move from the current account balance to CA star, we can see quite a large volatility in the line, which is the difference between the two measures. But you can see that this volatility mirrors the volatility in the current account series itself, and that it's largely driven by the R&D related IP import section of the adjustment. Today, we've also published new information on the US current account, quarterly and annual tables, but you can see here the annual series. And the current account with the US has gone from plus 4.5 billion in 2018 to plus 18.5 billion in 2019, shifting to minus 23.5 billion in 2020 and to minus 104.6 billion in 2021. And we can see on the graph that this is driven by changes in service imports from the US and income outflows to the US. But as we'll see over the following slides, this is not so much a change in overall service imports or overall income outflows, but it's more a change in geography, where they're going to or coming from. The service imports first. Our annual International Trade and Services release gives much more detail on our services, including by NACE and by geography. So looking at the figures from the most recent release, we can see that our total services imports have decreased from 19 to 20, but we're seeing bigger decreases in offshore centres and in Europe, while there's the large increase in imports from the US. So we can see that it's not a change in imports as such, but just a change in where these imports are coming directly from. And then looking at the income, usually when we talk about geography, we look at the next counterpart or immediate counterpart. But a useful concept in FDI in particular is to look at UCP, or the ultimate controlling parent, which is where we look at the geography of the ultimate investor or the ultimate controller of an enterprise. So for example, if we looked at direct investment positions in Ireland on an immediate counterpart basis, we'd see a wide spread of investment from Luxembourg, the Netherlands, US, UK, and so on. But if we look at it instead, from a UCP point of view, we see that the amount coming from the US is much larger, showing that a lot of this investment is coming ultimately from the US through different parts of the group in different countries. So looking at the income here, we can see the blue line is our income outflows to the US on a next counterpart basis. And we can see that big increase from 2020 to 2021. But if we look at the green line, this is the overall income outflows from US controlled corporations. And the increase there isn't as large. So we can see that a lot of the change is due to where the income is directly going to rather than the overall income outflows. And if you'd like to see more on FDI by UCP, you can see our FDI thematic release, which has a lot more detail. And then we're often talking about how volatile the services balance is. So we'd like to look at this over the last 10 years. And we can see here our exports and our imports excluding R&D and our imports of R&D. And we can see the blue line, that's the net, that is quite volatile, in particular in recent years where we've had large imports of IP. So I'd like to separate this out a bit to give a bit more detail on the trends. So looking first at the service exports, we can see that this has been growing continuously and strongly over the last 10 years, going from 81 billion euros in 2012 to 135 billion euros in 2016 to 294 billion euros in 2021. But we can see that while there have been increases in operational leasing relating to the increased aircraft leasing sector here, and in financial services related to the increased financial sector, far and away the largest driver is computer services, which have increased from 32 billion in 2012 to 58 billion in 2016 to 173 billion in 2021. When we look at the import side, again, we can see the volatility here, and we can see that it's clearly driven by the imports of R&D, which include IP imports of intellectual property products. So when we remove those, we can see again an upward trend right across the time series, where our total moves from 79 billion in 2012 to 141 billion in 2016 to 247 billion in 2021. And we can see that this is driven by our royalties, licenses, imports, moving from 30 billion in 2012, 69 billion in 2016 to 113 billion in 2021. Now, while you might expect our royalties and licenses imports to reduce as all of the IP is imported, this is actually happening. If we look at the individual enterprises involved, you can see that for enterprises that have imported IP, their royalty imports have drastically reduced. But what we're seeing is that this is being more than balanced by the strong growth in royalty imports for other enterprises throughout the country. So if we look at our services balance, excluding these R&D imports, just to give an indication, we can see a more positive trend, in particular from 2017 on, than would be given by the trend when you include R&D. So to summarize the results for the year, for 2021, we can see our merchandise surplus moving from 118 billion in 2019 to 142 billion in 2020 to 167 billion in 2021. Our services balance going from minus 105 billion in 2019 to minus 72 billion in 2020, up to 577 million in 2021, displaying that volatility that we just discussed. And our net income outflows have increased from 83 billion in 19 to 96 billion in 20 to 107 billion in 2021. And these all combine to give us a current account balance of minus 71 billion in 2019, minus 25.5 billion in 2020, and 60.7 billion in 2021. While our current account STAR has gone from 15.1 billion in 19 to 13.1 billion in 20 to 26 billion in 21. And just to look at our Q1 2022 current account, we can see our merchandise surplus has increased by 5.7 billion euros to 47.8 billion compared to the same quarter last year. Our services balance is virtually unchanged at 5.4 billion, showing 2 quarters with very low levels of IP imports. And our net income outflow has increased by 5.7 billion to 36.2 billion euros. And these all combine to give us a current account balance of 17 billion euros, which is virtually unchanged from the same quarter last year. So I'd like to pass you back now to Jennifer to summarise the results. Thank you.
Many thanks to Chris and John. I'll just pick out a few highlights as people develop their questions. As I say, questions through the chat function, or obviously we have the people in the room and we can take questions as well. So we've seen our revised figure there for GDP for quarter one 2022, 6.3% for GDP growth for quarter one 2022. The strong results largely unchanged across the board for 2021, GDP growing at 13.6% and GNP at 14.7%. Personal consumption, so what we spend on goods and services at 4.6%. I guess then moving into the modified indicators, the indicators that strip out a lot of the impact of the significant globalization effects on the Irish economic indicators. Modified domestic demand, which covers personal spending, government spending, and investment spending without the IP impact at 5.8% in 2021. So I think Chris has taken us through what's happening in the GNI star and in the kind of closely related NNI indicators there as well. So both are roughly at a level that's about half of the GDP level. So GDP at 426 billion. Of the level in current prices in 2021, and we have a GNI star at 234 billion and NNI at 211 billion. So we can see that significant impact of the globalization effects moving us from the 400 to 200 billion level for GDP versus the deglobalized indicators. But I think Chris mentioned as well the growth rates that are there that are happening on those indicators. So I think they're working very well as level indicators, but we were hoping in the second half of the year to do some further work with users on the modified indicators and new detail and analysis. And we've done this very successfully with users in the past on user needs around giving that insight into the Irish economy. So I think there's a lot done, but I think we can work on what more we can do, what new analysis are working, what new detail is working, or what maybe we need to change a bit as well. We're also into a time period as well where we'll be finalising new standards for national accounts and balance of payments or international account statistics in the coming year or so. So again, I think we would like to talk to users as well about what's coming there. But I would stress that the NNI indicator, which is part of the national accounts framework, it's something we worked on to develop a constant price version of as well. I think will feature more strongly, I guess, in the national accounts framework in the next version of the standards, as many statistical offices across the globe look to ways of giving insight on the deglobalized aspects of their economy. Okay, so look, we have some time for questions.